40 minutes are going to be very crucial. The stock on our radar right now is Bajaj Electrical. It's moved to the high point of the day. It's got a gain of close to about 1% right now. But today the stock, I think, has hit a high of 1259, which means it's very close to its 52-week high of 1265. That's what our data seems to suggest. When it comes to their Q4 numbers, the lighting segment was a bit subdued. On the whole, it's a good quarter. It's a revenue growth of 11.7%. Margins have expanded to 5.7% versus 4.7%. And the profitability is up close to about 32%. Anuj Poddar, the MD and CEO of Bajaj Electrical, is with us on the show now. Anuj, afternoon. This is Reema here. Can we begin by talking about your lighting business? Revenue growth at just 1% on a year-on-year basis. Profitability or margins have come under pressure. Tell us what happened in the lighting business.
So thank you, Reema, for having me. The lighting business, while it's flat overall, a professional lighting business is actually growing very well. It's a consumer lighting business that is soft, has seen some degrowth. We're seeing that trend in general and consumption side, where last 2 quarters consumer lighting has been soft for an industry, but I'm happy that we're making up for it through the professional lighting business. And just on an overall annualized basis, if you see lighting as it shows on your screen, the margins have expanded on an annualized basis.
Okay. What's the extent of softness in the consumer lighting business?
So in general, consumption demand across is, soft. We're seeing that in appliances, etc. too. It's in about a teens, so our degrowth in consumer lighting is in the early teens, and our growth in professional lighting is also in the slightly later teens.
Okay, all right. Hi, Anuj. Good afternoon. Anuj, if you could tell us, what about rural demand? I recall the last time we chatted, you had briefly mentioned that rural demand is still lagging. Any change out there, or it's still soft?
So to be honest, Nigel, I think rural demand is soft, but we're seeing that a little bit on the urban side too. But I do want to plug in or take the credit for the fact that our company, despite that, has actually grown our revenues and top line. And when I look at it versus industry, I think we're outgrowing them. So the good news for us is that we're doing that and gaining market share across most segments that we're operating in. And this is without dropping margins. So we're maintaining margin percentages, but actually growing the absolute profitability.
Got that. Hi, Anuj. I'm just going back to the consumer products business where there is growth. There's top-line growth about 9-10% year-on-year, but margins are under pressure, whether I compare it with Q3 or I compare it with the last year. Give us a little more color on what's happening with your appliances business. What are the trends like? And for FY24, what would be your expectations from the business?
Sure, Surabhi. So if I look at a consumer business, it is grown about 9%, which I would again call out is ahead of industry, which means we're gaining market share. This is in a tough environment. If I break that up further, our appliances actually grown fairly well. It's grown by almost 16%. Fans has been soft for us this quarter, or rather largely flat. Again, I think both of these numbers are ahead of industry trends. And this is done despite the fact that we've not dropped prices to actually hurt our margins. So our margins actually are up on a Y-on-Y basis.
I think last time you had indicated that on fans, there was some inventory, some of these non-star rated fans inventory that was hurting you all, and you all were yet to clear it. Could you give us an update on that? And what about the possibility of a price hike? Because you did say the movement, when the company needs to transition to BEE fans, there would be a price hike which you need to take to pass on the entire burden.
So the transition has happened or kicked in effective 1st of January this year. All our non-star rated fans from our side as manufacturers across the industry, we exited that as of 31st December. Having said that, Q4 has seen a fair amount of carry forward channel inventory across the value chain of these non-star rated fans, which is why the primary sales in Q4 for the industry has been soft. Relatively speaking, again, we managed a flat growth on fans, which means no degrowth, and we made up for that, quite honestly. Volumes have seen a little bit of a degrowth, but we've been premiumizing. Our portfolio mix is better. Our sales in premium fans actually has seen a pickup to contribute, or rather to compensate for the degrowth in the sub-economy fans. So on an overall basis, we've exited flat. I do think the outlook for the next 2 quarters for fans should be better, because as the channel inventory starts getting destocked, I think you will start seeing primary sales pick up sometime towards latter part of Q1 and definitely into Q2. And
All
the
right.
question on pricing, I think, to be honest, pricing is not fully passed on to the consumers. It's again a function of demand elasticity. So we've had to absorb some of this incremental cost because of the star rating and BEE, and only pass on part of that pricing. But that's baked into the margins, and that comes back to the original point I was making. I think you've balanced the revenue and the margins fairly well to make sure both are actually positive for us.
Okay, all right. Anuj, I recall a few quarters ago I asked you, I said, what about the EPC business? You said it's going to turn around. It's turned around. I think after a couple of years, we have a positive number on the profitability front from EPC. But what's the status on the demerger?
So, Nigel, the status on the demergers, our next hearing of NCLT is on 8th of June. Assuming that all goes well, that should be the last hearing, which means we are targeting a demerger effective end of Q1, that is 30th June. So that 1st July, we will be two separate companies. I don't expect any surprises on that. In terms of just the numbers on EPC, like you said, now after about 3 years, we've exited that on a break-even basis. But importantly, our order book is looking up. Our revenues are now trending up. Our order book, to give you a sense of numbers, was about 800 crores last March. We've exited this year at a 1,600 crore order book. Our revenues in Q4 on EPC are up. And I think this coming fiscal will see a growth in revenue on EPC with a positive profitability.
Okay, Anuj, so then leave us with a yearly outlook. I mean, FY23, if I look at all the businesses put together, you've had about almost 14% growth at the top line. The margin has improved, blended margin, decent expansion compared to FY22. So FY24, your sense on top line expectations and margin trajectory, can you better this 7% number?
Surabhi, I know you'd love to get a number out of me in terms of percentage growth, etc. Quite honestly, I don't know. We'll have to see how the market moves. But we're committed that we hopefully will keep finding the right balance between growing our top line without hurting margins. All things well, unless something worsens from here, I do expect margins to improve clearly. But most importantly for us, we are chasing market share growth. And we are quite committed that we will achieve that. We've done that for the last 3 years in a row.
All right, Anuj, good luck with the plans then. And thank you for joining in and giving us a lot of the details there on the business. That's Bajaj Electric. It's been quite a decent quarter for them and a pretty good, well-rounded year as well. Okay, with that, back to the market, which continues to be, I think, fairly steady. Has anything changed from 18,400? Well, a little bit, about 40 points shaved off from that level. Now we are getting into that expiry zone, the financial services, Nifty financial services expiry. Some of that interesting drama or the entertainment, as Nigel call it, that's perhaps going to start playing out. So we have our eye on the screen, but we also have to welcome in our